Thank you very much for inviting me to come and speak at the seminars. I'm taking the opportunity to present new work where I'm trying to work at a theory of banking, on a theory of banking that I think is kind of what we need. But okay, let me dive into the presentation. It's titled The Collapse of Small Business Lending in the US, Why General Access to Bank Financing Matters. And it's actually connected up to other work that I've done, but I just ran into this really interesting data set on small business lending in the US that I think makes an important point. So, all right. Quick outline. I'm going to give an overview, talk about the literature. I'm going to present this theory that I'm trying to articulate clearly, so hopefully you guys can give me some feedback on that. And then I'm going to present some data that shows how US banking really turned away from financing SMEs, small and medium-sized enterprises, and therefore turned away from generally accessible bank finance. So yeah, hoping we'll have a good conversation about this. So why am I doing this? I kind of evolved into this project after SVB collapsed, and I began to realize the degree to which the banking system, the US banking system, but kind of in coordination with the big banks in places like Europe, ended up financing and creating the private equity industry. So I'll have a few slides on that at the end. And to me, this is part of this problem, this self-referential kind of financing system that we have that's driving things like AI and crypto, and there's something really wrong with what's going on. And so what I want to do is try and develop a theory that looks at, so how did banking operate when it worked well? And a part of it is I'm an economic historian. I've spent a lot of time studying 19th century England and what did the banking system have to do with the Industrial Revolution and those kinds of issues. And so I think banks do play an important role in a functional economy. And I want to try... Merci. Yeah, so what I want to do is try and articulate, okay, what are banks when they're functioning well? And part of it is to articulate what's wrong with modern bank regulation, what's wrong with what got us into the situation where we are in now. Part of the opportunity to kind of just focus on this theory is this fact that I did run into this data that shows how remarkably the US large banks actually turned away from financing small business in the 1980s and just kind of completely converted their business model. So some of the implications I want to get towards are this idea that the banking system is this vast resource because it manages deposits which are connected to the money supply, and banks can expand the money supply. And so it just gives us this incredible resource base, which works really well when it's promoting the real economy, it's promoting commerce and trade. That's something that we want to see happen. There's a reason this system exists. But then, when it stops promoting general commerce and kind of being available to everybody, what happens when those resources are redirected? Historically, I think you could connect it up with bubbles and busts, but it also creates harm in the economy by leaving lots of beneficial transactions undone. So anyhow, let me get into the theory and see whether you guys buy it, whether you think I'm doing well. Interesting, there we go. So one segment of where I'm coming from is this literature on banks and liquidity. And if you spend a lot of time looking at how regulators are thinking, and also like I'm fairly familiar with the mainstream literature on banking, and there's just no question, like Diamond and Digvig, 1983, and that model of a bank run is kind of the basic framing for a bank. And so this is the story. Okay, what is a bank? A bank is an entity that funds long-term assets on a short-term or immediate-term basis. And because people can pull away their deposits, the fundamental characteristic of a bank is that it can fail when the depositors run. And if that's the key thing everybody should know about a bank. That's what comes out of this literature. And that idea just threads through a whole bunch of things. I picked out Beinsel 2019, who discusses this, but it's throughout both the mainstream literature and the regulatory literature, for that matter. And I want to pick up the post-Keynesian idea, and I think it's also Keynesian and even earlier, that we should maybe be thinking of banks. It's not that they aren't a source of liquidity risk, but one of their key roles in the economy is to be providers of liquidity. And if we don't think about the positive role that banks have, and why do we have banks, what can they do in a positive sense for the economy, then we're not really understanding what they're doing. So yeah, liquidity risk is something we certainly shouldn't ignore, but we need to think about why? Why did we set this system up in the first place? And that's that banks are a core provider of liquidity. Schumpeter, Business Cycles, published in 1939, has a really profound discussion of this idea that the reason you can have entrepreneurship and the reason that you can have economic growth, creative destruction, successful innovation that advances the economy is because entrepreneurs are financed by banks. And the things that banks can do that nobody else can do is create money to finance this new innovation the entrepreneur has. And why that matters is that the entrepreneur typically doesn't have collateral. They haven't succeeded yet. They have an idea, right? And so by expanding the money supply to finance the entrepreneur, the bank's going to allow this product to enter the economy without pulling money or production from the rest of the economy, right? Everything else can keep going, and I just finance a new activity. I can do this. But what that means is that essentially your whole kind of price and quantity structure that existed stays fairly stable. The banks aren't pulling money out of it. They're not deciding who wins ahead of time. They're allowing a new product to enter, right? And then demand and supply can figure out who wins, basically. So basically you're not destabilizing the existing structure. You can just throw something else in there and let market forces make the decision. And the key thing is it's because banks create money to fund this person with a new idea, that it can just kind of enter the economy. It can enter the economy as it exists now and compete on an equal playing field. That's where it's coming out of Schumpeter as I read him. It's also connected to Graziani and Pargas and Seccarecchia, excuse my Italian, and the whole theory of the monetary circuit, which also starts with banks issuing money that's going to be what it makes it possible for the economy to produce. And I also have some work where I actually was working in DSG model frameworks to talk about bank credit lines this idea that maybe actually the only reason you have general equilibrium outcomes are because you have banks providing credit. That's something that I worked on many years ago. Then, from an economic history perspective, you have work like that of Wicksell. And so Wicksell is actually one of the underpinnings of absolute mainstream neoclassical macroeconomic theory, and in part because they've picked and chosen from him. And if you read Wicksell, one of his ideas is it's possible to have a pure credit economy. We don't need money at all. We could all be trading just on the basis of credit. But if you read the theory, he's like, it's because the banking system is essentially providing short-term credit to everybody who is temporarily constrained. So you can kind of think about it, from a personal problem. Let's say you just got a job and your paycheck comes 1 month away. There is no reason at all that you should not be eating easily this month, right? Your paycheck is 1 month away. The banking system should be able to say, you have a paycheck, you can have money today to eat, right? And we'll count on you to pay it back. And of course, you can also think about business firms as facing all kinds of constraints of that thing, where it's like, you know what, it is really predictable that they will be able to get money in 3 months. And the thing is, they need to purchase a few things now. The banking system exists to make sure that those are not constraints that prevent production from happening, because it's kind of obvious we want that stuff going on. And that's actually the level at which Wicksell is looking at like a pure credit economy. He's thinking about banks as making this kind of credit accessible to everybody. And when he talks about pure credit economy, I think it is close to this idea that I'm getting to of generally accessible financing. There's also the Macmillan report in 1931 that it talks about this in a similar way to Wicksell. Okay. So what am I arguing for? And this comes out of my knowledge of 19th century banking. I'm going to argue for a theory of generally accessible bank finance, where this key bank role is actually short-term finance. The focus is commerce. The focus is just making sure that mutually beneficial transactions, that kind of you're lending absolute maximum for a year, because otherwise it becomes a little bit less predictable, right? You know, you're lending on a basis of, I know you're going to have this money in a few months, and you need a loan up front just to be able to do your transactions that are going to help you, do this production that is, it's just fairly clearly part of your business. It's a standard way of financing for actually agricultural activities as well. Like, you need to plant before you harvest. And basically the classic thing is the farmers all need to borrow money in the spring, and they pay everything back in the autumn and winter when they manage to sell their crops, right? And like, these things should not be stopped because there's a lack of financing, because that's just economic inefficiency, and it shouldn't happen. So basically the idea is that banks make short-term loans available to facilitate the smooth flow of trade. And then another aspect of what makes it actually a stable form of financing is that banks are financing what in accounting terms are receivables. If you ever worked in accounting offices, there are accounts payables and accounts receivable. The thing about accounts receivable is it's an accounting term for amounts due on goods that have already been delivered. Essentially, the only thing that's uncertain about this transaction is whether or not the buyer is actually going to complete the payment. We know the price of the good. It's already been delivered. There's kind of a completion to it. So there's no uncertainty whatsoever except whether or not the buyer will pay. And in this sense, financing these kind of activities isn't likely to have effect on prices or this kind of thing, because they're actually completed transactions, right? It's just, the only thing you're doing is making sure the buyer is not financially constrained. And then this other idea is that, well, wait a minute, this needs to be generally accessible. And the real reason is that we can think about reasons why anybody would face of financing friction. And I think the monthly paycheck is like the easy, intuitive one. But it's really hard to think of a business that wouldn't, in some cases, need to do this kind of borrowing. So it's kind of everybody needs this, and if you want an efficient economy, everybody should have access to this kind of finance. And whenever there are exceptions to that kind of access, it's going to mean that mutually beneficial transactions don't take place. So that would be like, that seems just obviously inefficient. Okay, so that's my approach. Then, because this is such a big part of the literature, there's this question of, can markets play the role of banks? And my argument is that no, and the key thing is that banks can expand the money supply, and what monetary expansion is doing is it's needed so that you can actually eliminate the constraints on commercial transactions. You don't want the bank having to pull money from somebody else in order to finance your transaction. The fact that the bank can expand the money supply, it actually facilitates entrepreneurship, doing new things, something else taking place. And this is a positive thing, because these are short window things we can be confident will actually be productive for the economy. And the other thing is that they can lend short term and they don't actually need collateral. If you're financing receivables, there's a lot of predictability to it, right? So there, you don't actually need to rely on collateral, which is another thing that can limit who has access to finance for obvious reasons, because it's rich people who have collateral. Then non-bank lenders don't have the ability to expand the money supply quite simply because they don't have deposits as liabilities. So if they're going to expand the money supply, they'd have to do it in concert with banks. And yeah, I've actually done a fair amount of work on like non-bank lending and this kind of thing, and you can actually track a bunch of these different channels about, okay, when you see a non-bank lender that actually expands the money supply, you can also see a bank credit line underlying it. And it's possible to kind of actually go through these examples in detail. Non-bank lenders also end up, because they can't expand the money supply, if they want to fund something, they need to pull money from where it's sitting now to fund something else. And this, I mean, that action can create distortions, and it's typically going to be something where they're going to want to have security or collateral. I don't know if you guys have studied repo agreements at all or that kind of thing. That's a classic market-based lending, which is completely collateral-based, but I would argue cannot have the properties of the kind of lending I'm talking about. I would say that the mainstream, including bank regulators, have kind of ignored the importance of banks expanding the money supply for years, and in particular, they've been arguing that market forces can substitute for bank lending. To me, that's one of the underlying mistakes of the evolution of our modern financial system. And it's really that there's a lack of understanding how banks are actually essential providers of liquidity. So that's kind of one of my big themes. So I want to connect this up with the literature on finance production and growth. One thing you'll find if you do the economic history side of things is that when you talk about financing growth, everybody's sitting here like, you need long-term finance that builds factories, right? You're talking about like building infrastructure and fixed capital formation, and this is growing out of the literature on Gershenkin, but it's a much broader literature. And so I kind of want to say, well, wait a minute, there's a whole other kind of finance that's maybe even more important than fixed capital finance. It's this tiny little short-term finance that just makes sure trade keeps going smoothly, right? So there's a contrast with that. And then on the heterodox side of the literature, Bessemer has done a bunch of work where he distinguishes between productive and unproductive or speculative financing. And the idea is that productive credit is going to finance real sector investment and innovation, which is associated with stable growth, whereas unproductive credit is going to finance existing assets, and that's what's associated with asset bubbles and crises. And I kind of want to say, okay, that was a good division, but the way I approach this, I want to propose something else. I want to talk about commercial, productive, and speculative credit. And the idea would be it's the commercial credit that would be reliably stable. The productive credit, because it's going to be long-term, if you're going to finance a factory, it's just a lot harder to tell how successful it'll be because it's not going into production for 2.5 or 3 years. And nobody knows for sure what the market conditions are going to be then. It's a much more uncertain investment. And then also we have so many examples of productive investment booms, whether you're talking about undersea fiber optic cables or whether you're talking about like data centers and this kind of thing. It's like it's not unusual to have a fad and have overbuilding of infrastructure. And then actually it's overbuilt, so the investors in that building actually frequently lose a whole bunch of money. But still, it was really good because we have the infrastructure and then we take advantage of it later. At the same time, you thought you were doing something brilliant by investing in that infrastructure and you lost money, right? So there's this, it's actually fairly common to have some boom-bust cycles in productive activity. And then I'm going to separate out a third category of speculative, which I would call the finance of zero-sum transactions. So instead of financing real economy things, it's literally like, whatever I gain, you lose, right? And when it's just complete trade-off, there's essentially no mutually beneficial gains in the transaction. I'd classify that as speculative. And I think those are ones where you can easily see they're prone to asset price bubbles. Using that, so I basically kind of have this framework where I think about commercial finance as something that's actually short-term working capital finance for firms, and all it's about is making sure as many mutually beneficial transactions as possible take place. And I would argue that's the core function of the banking system that you want to make sure you don't mess up, right? Because of all the things the bank can do, the most important is just to make sure trade goes along smoothly and isn't blocked by silly obstacles, right? And then productive is also important, but at least if you're going to look at the US and British model, the tradition has been, well, productive finance is something you should do on equity and bond markets. So, and now I'm talking about, this is the older tradition of banking, so it's kind of more like early, early 20th century, this kind of thing, that basically there was a huge turn in the 1980s where both the US and the UK said, we're going to let our banks get into the stock market. So you guys are looking at it like, what do you mean, banks? And JP Morgan is all over the stock market. That actually is something that basically is a phenomenon of the last 50 years, right? In an earlier tradition, it was kind of like, if you want to have long-term finance, that should take place on markets. And the banks, we want to have separation between them. That's part of what the Glass-Steagall Act, that kind of thing. At the same time, there was a completely different model, which we tend to associate with Germany, where banks are just involved in all of these kinds of finance, right? And certainly, I mean, I would definitely not say there's no role for banks in productive finance. I'm mostly interested, though, in not messing up the commercial finance of things. Like, go ahead and get into that, but make sure the commercial finance is working well, right? Before you get into productive finance and think about what constraints you need in that. And then at the same time, speculative finance, I think, is something that can fairly clearly be thought of as something that leads to boom-bust cycles. Okay. So one of the things I'm trying, I mean, the reason why I'm taking my time to do this is I want to be able to think through how should we analyze our current financial system. And so I think there's an element of banks as public resources, and this is, Hackett and Omarova's finance franchise. There are a lot of people who've talked about this kind of area, but since banks are funded by our deposits, there's an aspect of them that is fundamentally public. And you can conceive of them as being entities that have been granted the privilege of expanding the money supply. I want to add to this kind of aspect, I think most people, that's fairly recognized of them as being public in that sense. Historically, the way banks were able to draw depositors and were able to actually grow and become banks in a world that didn't have that many banks is because depositors were the same people who were offered working capital loans, right? And even if you think about a lot of traditions of mortgage finance, right? They frequently were done in building society or savings banks that would say, okay, if you deposit your money as an individual with me, and you have a history of keeping your money with me for 5 years, you will become eligible for a mortgage. So it was literally a trade-off. You deposit your money with me, I'll give you a loan, right? Or at least you'll be eligible for a loan. And of course, they didn't actually commit to give you a loan because if you're a bad credit risk, they weren't going to give you a loan even though you had been with them for 5 years. But at least you'd be on the list of people who are going to be evaluated for a loan and you should get a fair chance at it, right? And an aspect of what banking came out of is this idea that when you put your money in the bank, you have access to their lending facilities as well. This idea that they're public kind of has definitely been used to justify the lender of last resort support from central banks, because we want to keep public confidence, we don't want to have runs on deposits. And also this idea that banks actually have a fairly privileged role. They're highly regulated specifically so that we can make sure that they are that we have this stable money supply. But I want to ask, I think the way I'm framing this is I want to be able to have a framework where I can ask, what are the costs to depositors or to society when bank funding is redirected? It's no longer generally accessible. It's no longer everybody who puts their deposit in the bank has a fair chance at getting a bank loan, right? You're going to take those bank resources, which are built on all of our deposits and the money supply itself, and redirect it someplace else. Who's gaining? And remember, underlying this is my story. I can give you some data. 1980s, who gained from taking money away from small businesses? They created private equity funds. You want to know where Blackstone and BlackRock came from? The banks lent the money instead of lending to small businesses in the 1980s. And you can literally trace their growth from this kind of phenomenon. So that's one of the reasons I'm trying to create a framework where I can actually look at this from an analytic perspective. And I think the other thing that's underlying this, but that I really haven't developed, but I know could be developed a lot further, is what happens when certain groups are excluded. So if you're going to talk about a place like the US and US banking, like Mirza Baradaran, I think I got her name right, has written a book called The Color of Money. And it's this whole issue that the US had a banking system that worked really well through most of the 20th century. Some people were excluded from it, right? And so basically, if you were black in the US, you didn't have the same access to bank lending as everybody else. And this completely shapes the nature of wealth in the country, right? And so I think there also are aspects of that, like this model I think can really help you understand, like, where is this coming from? Why does it matter so much? So that's one thing that I'm trying to do. And then I think the other thing that I begin to get worried about, especially as I see what's going on with AI, is, can anything actually limit the growth of bank liabilities when lending is collateralized, or when it's like productive and forward-looking? Have we actually, by getting completely away from commercial-based lending, kind of gotten us ourselves into this world of bubbles where we don't actually know the value of anything anymore? That's another question I kind of have underlying. That's probably going a little bit too unfocused to really go through here. All right, 1980s. Thinking about regulation that worked against generally accessible financing. One thing is you can look at the Basel Capital Accords. And when the Basel Capital Accords were put in place, one of the first things they do is they make the capital requirement for a commercial loan twice as high as for a residential mortgage, right? And part of this is they're like, it's just risk. Residential mortgage has collateral, they have a history of not performing badly. Commercial loans are more risky. But as you can see, it's like, they're not worried about financing commercial activity at all. Like that wasn't on the list of the things they're supposed to be making sure are happening when they're doing this. And you're kind of like, not sure that was a good idea. And they also have fairly strong preferences for collateralized lending. This gets put in place in the 1980s. To be honest, these are aspects of Basel that, they have effectively not been changed. The residential mortgage collateral things have changed. They've gone up and down, but the preference for residential mortgages over commercial lending is still there in Basel III, right? And so if you want to see some of what happened in the 1980s in the US, Basel is actually fully adopted in 1987, but this is US commercial banks from 1979 to 1994. What the blue line is the commercial and industrial lending. It's lending to businesses. And what the red line is residential real estate lending. And you can just see, like, there's a complete transformation of banks' portfolios. And regulation is one part of this. There's a lot of other stuff going on. There's a huge story to tell about this. But you can actually see that commercial lending starts being less important in general to the banking system, right? And another aspect of what's going on in the 1980s is there's a huge push for the consolidation of US banking, because banks in the US are viewed as inefficiently small. There's this whole story, like the German model is the one that promotes industrial production and growth, so we need to be like them, we need bigger banks. And they also reject the separation of commercial banking and investment banking that had been put in place in the 1930s. And that's the whole Glass-Steagall thing. All of these things are going to be things that essentially make it easy for banks to turn away from this focus on commercial financing. So what I want to do is show you some data that hopefully you'll find interesting. And so this is data on SME, small and medium size enterprise lending in the US. Just so you understand why I'm using this data and not trying to get more recent data. Data on small business lending is actually hard to get. I have to admit, I have no idea what the situation is in Europe, but I don't think it's easy in Europe either. In the US, we have bank call report data, amazing resource. Every single commercial bank has to do a quarterly report, and it's completely detailed financial reporting. There are like 5,000 entries in there. You have a vast amount of balance sheet and profit and loss data. They have to do this quarterly, and anybody can go and look it up. For each individual bank, I can tell you what JP Morgan's income was in 1979, in the first quarter of 1979, because it's publicly reported. I can literally go through the details of its balance sheet. It's publicly reported information. So it's an amazingly useful resource. But guess what? The loan data is not collected on the basis of the size of the borrower. In fact, this category, commercial and industrial lending, has it tends to be this big block, like you can't look into it that easily. So it's this vast amount of lending, and you don't actually have a good idea of how you would break it down. So basically, when you're trying to figure out US bank small business lending, you're going to have to impute it somewhere. You're going to have to make assumptions and try and figure out what was going on. And the thing is, it turns out that from 1979 to 1994, some Federal Reserve officials did this study, and they literally sat down, they got complete data for 33% of the largest banks, and then they took the other, so they have complete data for the largest banks that comprise at least 33% of the banking system, and then there are another 15,000 additional banks, right? And they essentially they'd use selected data. They have selected data where you've done survey data across a whole range of different ones, and then they go ahead and they use econometric methods to say, okay, if we're going to take the data we have and figure out what's actually going on with the rest of these banks, this is how we can estimate it. But one thing to be aware of is the data on the biggest banks is complete, right? That's not the part that's missing, right? The part that you're imputing data on is basically for the small banks, because there are just so many of them. So they have collected data divided into 3 size categories of borrowers, into 7 size categories of borrowers, and I'm only going to focus on 3 of them just because it's easier to look at the data that way. So I basically do kind of a small borrowers, less than 1 million, large borrowers, I think it's greater than 10 million, in middle borrowers. And then also, they have 3 size categories of bank lenders. And this, so I end up, because it's this existing data set, I have to just take what they have. So they have mega banks that are huge, and for most of the data set, it only includes 3 banks, and then it actually has some bouncy factors because, 1 year it goes to 4, and then by the end it's become 5, but it's a little bit discontinuous because of the nature of it. It has such small entities. And then they have a small banks category that are less than 100 million. And then they have the rest of the banks, which actually ends up being most banks. So you're kind of capturing about 10% on one side, 10% on another side, and then the middle that's a lot bigger, right? So let me show you. All right, so these are bank loans. Let me see how much. Okay. Okay, so these are bank loans. One thing to be aware of is they were very careful to do everything in 1994 dollars. So the bank loans are measured in 1994 dollars. The green at the bottom, you can barely see it in the first set of columns, is the mega banks. And the first set of columns is giving you lending to small borrowers. The middle set is giving you lending to medium-sized borrowers. And the final set is giving you lending to large borrowers, right? And then if you look within the columns, the green is the mega bank lending. The blue is the middle bank lending, and the red is the small bank lending. And I think the thing that really jumped out at me when I looked at this, like, wait, essentially you can just see very clearly that lending to small businesses in the US, and remember, this is all of the US banking system's lending, right? So lending to small businesses literally dropped by more than 50% in real terms from 1979 to 1994. And also that $1 million breakpoint is also in 1994 dollars. So it's not, oh, wait a minute, the businesses were changing in size. That's all been calibrated to make sure that's kept in the same dollar amount. So it's a huge amount of real decline in lending. And I think the other thing that's really remarkable when you look at this is, and the large borrowers are the ones who are the beneficiaries of this. And more than that, like, wow, anybody remember? 1979 to 1982, what's the big phenomenon that's going on there? Yeah, the Volcker shock. So one of the things is you can see the Volcker shock here, and it's interesting, the Volcker shock has a huge effect on small businesses. The big businesses actually get a huge increase in lending. And I think that's something that many of us like, wait a minute, I didn't know that. I thought all the businesses got crunched in this. And it's like, well, actually, it has to do with credit line commitments and this kind of thing. But essentially, the banks ended up supporting the big businesses through the Volcker shock, and the small businesses got crunched. And then the other decline that you see here from 1989 to 1992 was actually a general credit crunch in business lending. But when you look at the numbers, actually, basically the small borrowers got hit much harder than everybody else. And the other thing is the small borrowers never recover, right, in terms of lending. Okay, so I've already said that. So there's a shift over this period from from banks of all sizes lending to small and medium-sized businesses to small banks doing almost all of the lending. And so here, all right, so this shows the middle banks. Well, I have another slide that shows the other ones. You can see the middle banks in 1979, 40% of their lending is going to small borrowers. By the time you reach 1994, they're like, nope, it's declined a lot. And just so we can see things in scale better, similarly, 25% of the lending of the biggest banks used to go to small borrowers. By 1994, it's 2%. Right? At the same time, the only ones who are continuing to lend to the small borrowers are the small banks, and the small banks, due to consolidation in the banking industry, are actually shrinking themselves, right? So there's this real movement away from bothering to finance the smallest borrowers. So one of the things that you can see here is that there are some serious myths in terms of how this was discussed. Janet Yellen, it's interesting. She was one of the people who testified in Congress when they had an investigation of small business lending in 1996. She was a member of the Federal Reserve. And she literally says, you know, yes, there's been a decline in lending to small borrowers, but markets are going to ensure that small banks meet borrower needs, even if large banks step back. Like, it's just kind of like markets are there, markets will take care of this problem. There's this incredible confidence that this will happen, and yet very little evidence that it actually does. And by the 1990s, people end up saying, oh, small banks have always been the ones that support small borrowers. And I think that's the one that's the one that triggers me. I'm kind of like, that's actually not true. If you want to look at what happened earlier on, 25% of the largest banks' lending used to go to small borrowers, and they just stepped away from it, right? And I think that we don't have data of equal quality for the 1960s, but what we do have for the 1960s makes it clear that the biggest banks were very much involved in a lot of domestic lending, much more so than in 1979, and the difference between 1969 and 1979 is actually foreign lending. The 1970s were a decade of huge growth in foreign lending by the biggest banks, and it meant that domestic commercial lending by the biggest banks in the US accounted for 25% of large bank assets in 1969 and only 12% in 1979. That decade's a huge change, and it's basically due to the growth of foreign lending. And then in 1969, your large commercial banks accounted for 75% of all C&I lending. And so basically, it used to be the large commercial banks, the largest segment of commercial lending, and that one of the segments that they paid attention to was lending to small businesses. And that's where I'm coming at. Like, I think this fits in my little model of generally accessible finance. There was a time when they did this. And in the 1980s, one of the things that happens is they step back. And essentially, it's a two-step process. First, they shift their focus to foreign lending in the 1970s. And then when that goes bad, you folks may be aware, so 1982, Mexican default and the Latin American debt crisis. So at that point, what's happening is that they shift the syndicated loans they've created to lend to developing countries, and they use that same structure to end up lending to big firms. And it's essentially what creates the private equity boom, is the big banks are like, we want to lend for your takeover of Revlon or whatever company it is. We want to create this activity. So I think of that as something the banks created. Here's some data that comes from other work that I've done, just so you can get a sense of the big banks' involvement first in the foreign lending. These are the losses that the banks realized in 1987 after their whole mess of foreign lending in the 70s. There was the debt crisis in 1982. The US government said, okay, you cannot realize these losses now, because if you realize them in real time, 7 of the 10 largest banks in the country would have failed. So we're going to give you some time. They ended up taking at least the biggest chunk of the write-offs in 1987. And if you notice, Citibank wrote off, that's $11 billion in 1 year, in 1987. So, and in fact, what it wrote off was essentially 7.5% of its balance sheet. Right, and that's 1 year's worth of write-offs only due to foreign lending, right? And it was the biggest year. Basically, they had been kind of strung along for a while, and then they're like, okay, now you can take these losses that you hadn't taken before. But you'll notice that, so these are the banks, the 20 banks that took the largest losses. As a percentage of their balance sheets, way too many of them are like 10%, 9%, 8%. I mean, this was a huge thing they were engaged in. And you can also see their rank by assets, just so you can tell it pretty much is all of the biggest banks with 1 or 2 exceptions. So that was the foreign bank lending, and what I actually have been working on in correlation with this is looking at the deal scan data. So the deal scan data is essentially the leveraged loan lending, the private syndicated lending by the banks that supports things like leverage buyouts. And what they were doing in 1907, 1988, and 1999. And essentially, there's a huge correlation between losses on the foreign bank assets and the lending here on essentially lending to support the growth of private equity. And the other thing is that it's the banks that are completely involved in this growth. So kind of the other side of this story, the story I tell in the paper that I distributed, is basically they stopped lending to small business. The flip side of it is that they started doing all of this private equity lending. So all of these big banks, when they turn away from lending to small businesses, what they're doing is financing private equity deals, right? And yeah, and I think one of the reasons the bank regulators think it's a really good idea is because they want the banks to grow out of their foreign losses. They have a whole bunch, the whole top sector of the US banking system was effectively bankrupt in 1982. The bank regulators can't afford to close down that many banks, so they want them to grow out of those losses, and it turns out that doing high-yield debt to the biggest companies in the country seems like a really safe way to grow out of your losses. And that's one of the reasons the bank regulators do it. I mean, nobody's kind of taken a macroeconomic perspective and saying, what are the consequences of these decisions if you think in a long-term framework? They're just like, I want my banks to not fail, right? Anyhow, so this is kind of, this is the underlying story that I actually want to connect this up with. And so what I presented here is basically just, I want to have a framework for understanding why this is such a huge problem, right? So basically, what's my story? The largest US banks used to fund small business. They used to provide what I would call generally accessible finance to just try and make sure trade and commerce works and we get as many mutually beneficial transactions in the economy as possible. In the 1970s, they get into foreign lending and the largest banks failed. Then they grow out of their losses by changing their lending practices, and in particular, they stop lending to small firms, and they refocus their business on their largest customers, but also they like high-yield loans. They like it when you load a big corporation up with debt. And yeah, again, one thing to be aware of, you guys should look up an LBO structure. The craziest thing about private equity debt is that you have this small company that's putting in a little bit of money, and it's borrowing billions of dollars, say 65% of a company's value from the banks, in order to purchase a company. And the trick on this is who owes the debt. That company that ends up owning what was once a public company does not owe the debt. The debt gets put on the public company itself, which is no longer a public company, it's a private company. So there's this weird trick with leverage buyouts that anybody who thinks about it is like, that should not be legal. Why is that legal? And the thing, it's like, so take a look at it. If you actually look at it, you're just kind of like, they aren't actually letting them do that, are they? And it's like, well, in fact, they are. So basically, the banks are sitting here saying, oh, okay, I can get a high-yield loan, and it's backed by all of Revlon's assets. It's a good deal for me. Anyhow, so that's part of what's happening. So what I really want to do, where I'm kind of thinking long-term with this, is I want to think about the redirection of vast banking resources that once went into making sure that the economy functions well, we have a lot of commerce going on, it goes smoothly. That can actually reshape the structure of the economy itself and be destabilizing. And also, that one of the costs that we don't even think about of what's happened is that we've completely turned away from even the concept that, hey, every small business should have access to reasonably priced working capital finance. And it should be said, that should be one of the key jobs of the banks, is to make sure that small businesses kind of can go into operations easily, financing is reasonably priced, and that should be one of the key focuses of what we think of our banking system is doing, because when you take that away, that probably is going to affect growth more than others, but proving that is always the trick for me. Anyhow, I don't know. I can't prove it, but that's my theory. Anyhow, okay, so that's my story. Hopefully we'll have a good conversation about this. I guess, or we do questions first, or, yeah. Okay.